Hey, welcome to today's podcast. Today is June 5th. One more day till I become a little bit older. 41, for those that are wondering. Tomorrow, June 6th, D-Day. It's doomsday for me. Another year on the calendar. But I guess it could be worse, right? I could not be here, I guess. Anyways, welcome to the show, the podcast. The stock market continues its little correction here, and you can see the S&P 500. It was down about 22 points today. It's getting closer to that 1,600 level that we've been talking about. The Dow Jones was down over 200 points, finishing on its lows of the day. NASDAQ down 44, holding up actually the best of the bunch. We'll talk about that in a minute. Treasuries finally reverse course and actually go up. Volatility spiking. So all these things that are interconnected are doing what you would expect them to do, given the fact that we are correcting. Now, we've talked about these levels. I took off the arrows and replaced it with a box. For the last podcast, we talked about somewhere in between the bottom end of this box and the top end of this box. And it would make sense for a couple of reasons. Number one, just look back. Let's zoom out here from when this started, which was mid-November. This uptrend that's been intact, we're at the bottom end of it now. Now, if you were to squint your eyes, there's been a few times it's broken out. This time it didn't quite reach the bottom, but generally speaking, this thing has been in an uptrend since mid-November. So we have gone from overbought to pretty much oversold. For all intents and purposes, we are oversold now. Not in a huge major way as like the end of 2008 or beginning of 2009, but if you assume that this uptrend or this bull market or whatever you want to call it is still in place, then we are getting to the oversold place. The other thing that could happen is this market isn't always perfect, and it's not going to stay in this little channel forever, and so there could be a time where it falls out of this box and continues further. And this is kind of the next line in the sand, which would be, let's call it 1550. That would be a bigger correction. You could even point a little bit lower to this moving average here, which would be down in the 1500 level. All of this, by the way, would be perfectly normal in the uptrend. So don't let that scare you. I do not believe that this is the top or the end. I really don't. And I think that because we haven't had the classic warning signs yet that we typically get. Now, the only time I've seen these warning signs not be there and all of a sudden the market turned into a 20% correction was 2011. Remember in 2011, our debt was downgraded, and within just a few days, the market had fallen 22% from its high to its low. Well, it didn't fall 22% in a few days. It took it a while, but it did fall probably 2/3 of that within a very short amount of time. And in fact, if we take a look at the weekly picture here, and we'll zoom out, here's 2011 right in here, and you can see it did fall rather dramatically. These are weeks, so in 2 weeks, it gave up a big portion. It was at 1340, and it fell all the way down to 1166 within 2 weeks, very quickly. Then it gyrated back and forth for a while, went back up, came back down, and finally kind of broke out, and up we went. But that was a nasty, that turned out to be a correction, but technically it was a bear market because it was over 20%. Right at it, and so that wasn't. We didn't have much warning, so those can happen. It's not. I mean, we're not. This isn't science all the time. There's an art to this sometimes, and I think what's happening right now is we are correcting in an uptrend. But I'm going to bring up that weekly picture again for a couple of reasons. This is the S&P. And of course, when we go back, if we were to go back a little further, you could see this line right here represents kind of the old highs, and now we've broken through it. So that's why I say it's possible that we could come back and test, eventually come and test that old breakout and then go up. That would be, high 1400s, maybe around 1500. That could happen, and this could be the time it does that. But it's too early to tell. For right now, I think, again, for powder you have dry, what you have to start doing is averaging in on the way down. We've talked about that. If you're under invested, averaging in on the way down. And that means if you're somebody that is looking for income, averaging into dividend-paying stocks is what you should be doing with part of the portfolio. And the reason why is because People are freaking out right now that the Fed is going to start tapering their bond purchases, meaning they're going to drop their purchasing from $85 billion a month down to who knows what, $80 billion a month? They're going to drop it down from an astronomical number to a ridiculous number. But during that time, interest rates have been going up the last month because people have been scared. Today they dropped quite a bit. They dropped to basically 2.1%. And as the fear trade was there, people exited stocks. They bought a little gold. They bought some treasuries. And so that's coming back down. But here's the thing. During this time, as interest rates rose, anything that looked like income, whether it's utilities or REITs or bonds or anything that's even supposed to be a low volatile type investment, has been hit because rates have risen and people have worried that perhaps the low is in and we will not see lower rates again, and that's it. But again, you have to look at the economic data that's been coming out, and it's all been coming out weaker than expected. Not all of it, but a lot of it. And we had the ADP employment today. That was the first in a series of 3 employment reports we'll get. Today's ADP, tomorrow's initial jobless claims, and then on Friday we get the government's payroll numbers. And today's disappointed. So, you're looking at going, okay, well, if we don't have gangbuster employment, is Ben Bernanke really going to slow this thing down? And I don't think he will. But the market has been pricing in the fact that they think he's going to do that. And so you've been seeing this safety trade come off and people going into cyclical type things. That is reversing in the last few days here. And so getting back to the S&P, we're in its corrective phase where now you're starting to see gold do well, treasuries do well. You're seeing the utilities and REITs on a relative basis beating the major indices. So that's what's been happening the last few days. So we're at this point right now. Could we fall a little further? We could. But if you're somebody that's looking for income, as I mentioned, and you've seen income producing things get hurt in the last few weeks here, what you have to do is diversify away to realize, okay, how much of my stuff is interest rate sensitive, and what is my hedge here? Well, your hedge can be, if you own some bonds, your hedge is dividend paying stocks, right? Because they've been moving opposite each other. So you have to balance these things out. So I've been buying some of those on the way down here, and I think that's what you have to do if you're going to navigate in this market. But to me, this still looks like a correction, and we're at the point right now where we're getting oversold if this is a market that is still in this uptrend. And by the way, we could be starting some type of summer, kind of volatile period like we had the last couple of years. Or maybe we do break down a little bit. We have a little rally. There's a lot of head fakes in here. It goes kind of up here, does this, kind of goes up here. But at what's really happening is when we kind of zoom out and look at maybe some of the moving averages, is that perhaps the 50-day moving average just starts going sideways as we're zigging up and down, zigzagging up and down over it. That could happen too. Let's not believe that the market's going to go straight up, but let's also not believe it's going to go straight down. And that's where income comes in over the long run, and that's where trading comes in, and having to merge those two things. My model suggested that the sell-off that we are experiencing now would have come earlier last month, and it actually waited until about the 20th of May. I was positioned for it more in the middle of May, and as you can see, the market continued up a little higher, and now it's coming back down. So my models were a little early in suggesting that this sell-off was coming. Now, we did talk about, a few podcasts ago, we discussed the fact that looking at the market in conjunction to where the stock market was in conjunction to where these moving averages were and how stretched it was. And now you see it's not as stretched. And I think we had a blog post, a few blog posts maybe a couple of weeks ago showing how stretched those were historically, that was a time for a correction, and it's coming back in now. But that doesn't mean it turns into a bear market. It's just saying where things overbought, and I think they were. And so here we are now, and now we've swung to the other side, and now it's getting oversold. Now this downtrend won't end technically until we close above kind of this level here. Because if you're a bear, what you're hoping for, well, if you're a bear, you're hoping for it to go straight down. But also you're hoping for a bounce that's lower So what happens is this is an old high that won't be reached, and it starts to work its way lower. And really, one thing that's been helpful the last few days has been this hourly picture. This is an hourly picture, and you notice that the uptrend that was in place on an hourly, again, this is a shorter time frame, but this hourly picture broke, okay? And once it broke down here and it tried to come up, it didn't meet the old high. That's when we started getting these lower highs, okay? And that's what happened. And so, again, what we're looking for now is for this to reverse course and start doing this number and working higher. But that's why I point this out on an hourly picture, because if we go back to the daily, it could be the same exact thing, but just zoomed out a little bit, where we get a bounce and then we get lower. And so obviously that would turn into more of a bigger correction, not just this few days. But isn't it amazing to me? It's amazing when whether you're reading Twitter or watching television or listening to radio broadcasts or podcasts, whatever it might be, that it's amazing how quickly people change their attitude, right? They're major bulls up here, and now they're major bears right here. And the bottom line is, people that said they wanted to buy the dip, where are they right now? I mean, if you go back and look at this, what's happened in the last few months, we've had a few dips here, right? And during those times, everybody felt like that was going to be the end of the run, and yet it hasn't been. So why would this be any different? I'm not saying it can't be, but until proven otherwise, it still looks like the uptrend's in place for now. So we could break it a little bit, and all the technicians would say, uh-oh, we broke it, and then just head right back up. But here's the thing the market's struggling with. The market is struggling with, and it's happening to the NASDAQ, it's happening to the Dow Jones, it's happening to mid-cap stocks, small-cap stocks. The market is struggling with this debate, right? The debate is the economy is growing, so the Fed is going to taper. Housing is doing great, so the Fed's going to taper their purchases. Okay? So if that's the case, interest rates should be rising, stocks should be going up, and that's what's been happening for a few weeks. But then we get this weak economic data coming out. And to me, it suggests the Fed's not going to taper. So then you have people that say, wait a second, the economy's, maybe it's slower than what we thought. So they start buying treasuries and selling stocks. And the stock market's going to be very confused here, because let's say the jobs report on Friday comes out worse than expected. Is that good? Don't you want, if you're a stock bull, don't you want the Fed to be engaged here and keep printing more money, because that's what's made stocks go up? But yet you don't want the economy to go too slow, because then it can turn into a recession. So it's weird. It's this Goldilocks where the economy's lethargic and growing, and housing's doing better, autos are doing better, but now we have higher rates. So will housing slow down? And the jobs picture's murky? So we have to have this 2% growth in the economy for the stock market to keep going up and interest rates to stay where they are. And that's the part that the investors are struggling with right now. They don't know who to believe. They don't know which economic report to believe. But and Friday's jobs report's not the be-all, end-all, but it is going to give another clue as to what's going on here. And I think the number's 165,000, something like that is the estimate. So if we come out with a number of 100,000, the bond market will celebrate that, right? Because that's going to be a bad economic report. What will the stock market do, though? I could argue both ways. The stock market could rally, because that means the Fed is off the table and they're not going to stop doing what they're doing, and the stock market should keep going up. On the other hand, is the economy slowing a little too much, and there's not enough jobs to support the housing market, and there's not enough jobs to support the automobile sector? Those are the things that will start to worry. When is bad news really bad news, right? Because right now bad news has been good news. If an economic report's bad, we know the Fed's there for us. But the bottom line is to all of this, I think the stock market's going to continue higher. And whether it's now or whether it's in a month from now or 2 months from now, even if it comes down into this range and then bounces, I think ultimately we're going to go higher. And because, again, if you're an investor right now, in the big picture, what are your options? The Fed continues to force people. They're forcing them into other areas, right? Here's what happened. Let's look at it from this perspective. Let's take a stock like Verizon. Or let's take the IYZ. This is a telecommunications sector ETF, okay? And it had been leading. And it pays a nice dividend, right? It's got AT&T in it, Verizon, 4%, 5% dividends. So what happened was bond investors were saying, well, I can't get much for bonds, and I'm not getting paid anything for CDs and money markets, so maybe I'll go to these dividend-paying stocks like utilities, telecoms, REITs. So they're forced to go in this area, right? And they're buying those. Well, now guess what's happening? Because the Fed's threatening to take away the punch bowl, now those are starting to fall. And so you're getting these falling, you're getting utilities falling, REITs falling. So now what do investors do? Well, now they have to go to, where else do they go? Well, now they have to go buy just regular old stocks. So I still think at the end of the day, it's still about the stock market. And I think the stock market is still one of the only games in town. But we have seen a big drop in things like the Nikkei, not Nike. We've probably seen a big drop in that too. But we've seen the Nikkei has dropped from what the high was almost 16,000, and we're down to 13,000. So we've seen a 3,000 point drop, a 20% drop on the Nikkei. A lot of people are saying, hey, that's going to be a buy here pretty quickly. So watch the Nikkei. But that was the first to kind of roll over, and then Europe, and then the U.S. And don't forget, we also have volatility spiking up here. Again, if you believe this rally is going to continue, when was the best time to buy stocks? It was here, here, here. Doesn't this kind of look the same? So again, if this is a correction and an uptrend, this is the time to be buying some things. But just keep the whole thing balanced, because again, if you're somebody that's all stocks or all bonds, you know, you're getting frustrated one way or the other. Bonds had a really bad month last month. This month stocks are having a really bad month. That's why you got to stay balanced here. How much of that balance you should have obviously depends on your own situation. I do want to touch on the NASDAQ here real quickly. I think that what we're seeing is the NASDAQ held up a little better than the other indices today. I think technology is in a very interesting area right now. I think there's a lot of good things happening in technology. I think with the dollar strengthening, as it's been strengthening the last few months here, I think technology stocks are in the right place right now. And I think overall you've been seeing them hold up better. And I think they're at a point right now where they were lagging the market, and I think what you're going to start seeing is they've just recently started to kind of outperform very subtly. They're in that kind of sweet spot where on a relative basis, again, they're going down. They went down today, but on a relative basis, I think they're outperforming the market. And don't forget to look at the things that have been beaten up the most. You know, when you talk about utilities or bonds or REITs or telecommunication stocks or staples or things like that, or gold miners, those things have probably the most potential to pop here right now, because there's a lot of things coming off the table. Things like financials are falling the fastest, and materials, and things that have rallied seem to be coming down the hardest. And so that's why it looks like more of a correction to me than an overall, rotation going on. All right, well, don't forget to send me your stock tickers if you want me to talk about them on a podcast. I'd be glad to do that. And you can email me. That's fine as well. Don't forget, we're on Google+. We're on Facebook, karleggers.com, eggerscapital.com. We're also on iTunes. If you have an Apple TV, there's a pretty cool podcast section. You just go search for Karl Eggers. You'll see it on there. You can put it as a favorite and watch it just like a TV show. It's pretty cool stuff, pretty neat technology. So we're on all those different places. So thanks for joining me. Appreciate it. Have a wonderful evening.